Best ever listeners, how you doing? Welcome to the best ever multifamily syndication show. Looking forward to our conversation today. We have a guest that is focused on, well, guess what? Multifamily syndication. And his portfolio consists of 10 apartment communities, around 800 units. How you doing, Vince? Get things.
Doing great, Joe. Thanks for having me back on. It's been a few years, so we have some updates, but happy to be back on.
Well, looking forward to the conversation and catching up. Vince, you want to start with, well, first off, Vince, the owner of Wheelbarrow Profits and Tri City Equity Group, based in Dallas, Texas. And as I mentioned, he's focused on multifamily. He's got 10 complexes, around 800 units. So, you want to tell the best ever listeners a little bit more about your current focus and what you're doing right now?
And absolutely. So, like you said, Tri City Equity Group, that is my main company. That's where I hold all my wealth. That's what most of our listeners here are here for, is the multifamily. That's what I've been growing since 2018. We've been growing Tri City Equity Group. I think we officially crossed the 100 million in assets under management. So that was a big milestone, especially for a lot of multifamily operators. So that was a big accomplishment last year. Since then, we've added a little bit more complexities to the mix. So now I own the small business aspect as well. We started rolling that in a couple of years ago in 2020. So I own a couple of home service companies. I really like home service companies. They're very easy to understand, easy to cash flow. So I have a couple of those. And then I recently acquired Wheelbarrow Profits Academy. That's part of the Jake and Gino brand, and we acquired that. So now I'm bringing that community into the mix as well. So doing a lot of things, but all the things I'm doing, the bottom of the funnel is multifamily. That's where everything ends up is multifamily. Wealth creation, wealth generation there.
And I thought I recognized Wheelbarrow Profits with Jake and Gina. So. Thanks for helping me connect the dots. So, are you a? Or did they create a franchise model, or what's the tie-in here? Help me understand that.
It's more so successor of the thing. So it's not a franchise. So
Mm.
I came through Jake and Gino as a student, just like 1,200, 1,400 other people. And in 2020, I came back as a coach. So I've been coaching for the last 5 years. And then last year, they wanted to kind of like maybe semi-retire or whatever their pivot is. They kind of want to look into other things. And they saw me as a possible successor for carrying the torch to the next generation of multifamily investors, and wasn't going to say no to that opportunity. So took it on. And it's definitely something very different than anything else I've ever done. A lot of the multifamily business, a lot of the home services doesn't translate well to coaching, but as far as running a coaching business, but I love learning new things, and I'm excited for the challenge, and I'm excited to share everything I've learned in multifamily, since 2016, and get the next generation of multifamily investors going.
And the home service companies. I obviously want to spend our time on multifamily, most of our time on multifamily, but I am curious, what services do the home services companies provide, and is there any overlap with the multifamily business that helps with some efficiencies?
Absolutely. So the start of the home service company actually came from when I was getting out of the military. I was going to, essentially give up my W-2. And as we know, a lot of the multifamily, you have passive income. Well, passive income is great unless you want to go buy a house or get a loan or go buy a car. The banks don't really like passive income a whole lot. They'll discount it heavily if they accept it at all. So the reason I got into home services to begin with was, all right, I'm going to trade my military W-2. I need a civilian W-2 to have active income so I can, still be credit worthy, essentially. So that was the original reason for that back in 2019, 2020. I landed on franchise. It was an insulation franchise as my first company. So I bought that. I scaled that. We were up to 12 territories for a time. I've since scaled back after learning some lessons about how these companies run, and we got a lot leaner. So we're still at about 7 territories, but we're doing really well there. That was the kind of dip my toe in the water of home services. Then, like a good asset manager, that's the hat I wear in Tri-City. I'm going down my quarterly reports and my P&Ls, and I'm like, we're spending a lot of money on flooring. I bet I can cut this out. So first, I do First, you go to the wholesaler, then you start ordering pallets, then you start ordering shipping containers for stuff. And then this opportunity came up to actually acquire a flooring company showroom. And it was your typical mom and pop looking to retire, needing to get out of it kind of thing. I scooped it up, learned how the flooring business works. And now we're bringing that wholesale model to my company, Tri-City, for that efficiencies in there. And then now we're, not only can we do it for Tri-City, so Tri-City can run more efficient and we can get the savings. Now I can offer that to other apartment owners because I know exactly what they think. I know how they run the numbers. I know how what their pain points are. So I can have a pretty good audience to wholesale flooring to now.
What is the discount relative to retail pricing on your flooring?
So typical retail flooring, we're talking LVP is usually what people use. So I'll stick to that for context. So your vinyl planking, typical markups are going to be 40 to 60%. That's your typical retail markup. We're doing like 10 to 15% markups on wholesaling, which is really interesting. And I want to get too deep into like the technical stuff of it. But the aha moment I had when I bought this company, all the guys have been doing for 20 years kind of gave me the crash course on flooring. And he's like, the stuff that you're getting from Home Depot and Lowe's and all the big box office stores, he's like, that's like the lowest quality stuff. Like, it might say Mohawk on it, might say Shaw on it, but it's not the same stuff as what pretty much any retail flooring company has. It's kind of like Costco, where it's like, yeah, they sell the same thing, but it's really not the same thing. It's like always like, 10, 20% less quality. The flooring industry operates the same way. It's like, yeah, you can go to Home Depot and pick a Mohawk floor off the shelf, but it's not the same as if you go to an actual flooring company and get it. So that was kind of like my first aha moment. And then once I saw the markups, I was like, oh, we can clean house on 10, 20%, 10, 15% markups. I was like, we'll have a big audience for this product.
And you have 10 properties, about, what did I say, 800 units. And as you mentioned, you crossed the $100 million mark in valuation recently. Is that correct?
Correct. Yep. Right around there.
Okay. So my first question is, you got a lot going on. And so how do you invest your time? How do you determine where you invest your time with an installation company, a flooring company, overseeing the coaching program for Jake and Gino brand, and oh, by the way, 10 apartment communities, 800 units?
Yep. And we're also vertically integrated too. So we own the property management company too.
So there's that.
There's that. So I think it's like 6 total. I don't think I'm particularly smart in any particular way when it comes to stuff. And I didn't really reinvent the wheel. So Traction, EOS, a lot of your listeners probably read that book, Gino Wickman. That's pretty much what we operate on. Is we set the frameworks, the system processes from either Vern Harnish or Gino Wickman's books. Vern Harnish is Scaling Up. And then you have the Traction EOS model. So pretty much create the blueprint on that, on your accountability, getting the right people in the right seats, making sure you have the right people in the right seats and they're bought into the company, and you compensate them well, and then that gives you the time to free up. It's way easier said than done. It's probably one of the hardest things I've ever done, is to try to step out of working in the business. But for me, that is how I do it. Is I'll buy a company and I'll find that one person to put in place, either COO or GM. For my service companies, it's a GM. For my real estate companies, it's more of like the COO asset manager position. But essentially, it's the same thing. It's that day-to-day operations person, that GM, get them in place, get them operating on that EOS model, and having that culture of accountability has been how I've been able to do this. And I don't think if I were to rate myself today, as we're recording this, I'm probably operating at like a C plus, B minus level. I know there's areas that I need to improve on, but it's one of those things every day I'm conscious of. I need to fill this seat with the right person. That's my mission for the day. So that's how I do it, is essentially run the Gino Wickman EOS model.
Do you have an integrator that you work with? And we started using EOS and I love it on the Ashcroft side, but
Yeah.
I'm curious, how do you implement it and integrate it?
Well, that's probably why I'm a C plus and not an A, is because I don't have an integrator all the time. So we started with one and we got everything set up, and then I made the mistake that 99% of people doing EOS do. Like, oh, we got it, we can figure it out. and then you slowly start sliding, right? And that's probably what most people do. I think we do a pretty good job internally of holding ourselves accountable, but I do know that there's areas that we need to improve on. But we don't have an integrator anymore. We try to self-implement, and it's not the same, but it's still better than doing nothing. So if you're doing nothing, it's way better than that. Even if you can implement 25% of that system, you're going to be way better, a lot less stress, a lot more accomplishments, each quarter, each 90 days than you were not having any framework to work off of. And then the implementers are expensive. So that's usually why, anybody that's done this, they might start at $4,000 or $5,000 a session. And so a lot of people, they'll do one or two and then like, I got it. But it's not the same as having it ongoing.
You are involved in 6 companies, you had mentioned. What is the 6th? I've got multifamily, installation company, flooring company, Jake and Gino thing, property management. That's 5. What am I
And then
missing?
my own personal holding company, Villanatics. That's where I kind of keep my stuff off
Okay,
to the side. So I'll do my small multifamily. This stuff I just do by myself. So fix and flips, small
got it.
multifamilies. That's
Okay.
that's my own thing off to the side. So Villanatics, and that was actually my first company, and that company is transitioning now to a holding company that's holding all of my other ones, kind of like a Berkshire Hathaway kind of thing, where he bought the one company and then that
Sure.
company kind of turned into the holding company.
When with EOS, for those who are not familiar with EOS, there's a meeting that's done typically weekly, and it's called an L10 meeting, a level 10 meeting where the leaders of the organization meet and get aligned on goals. They call them rocks for the quarter and a scorecard. So determining how you're doing on key metrics, talking about issues, problems, and it's from my experience, and you have more experience than I do, it sounds like, Vince, on this. It's about an hour and a half or so meeting. And my question to you is you're involved in 6 companies. I'm assuming the personal holding companies is not factoring into this L10 stuff. But how many L10 meetings are you in on a weekly basis?
Well, I have at least those five. And then inside of Black Sand, which is the property management company, I do one for each property as well. Well, one for each property manager. So some properties are combined into because they're smaller. So one for each property manager. We do that on Tuesday. So Tuesdays is not fun. That's pretty much just level 10s all day. And then I try to spread the other ones out. So, but each company, so I'll do one for Magic Carpet, which is the flooring, or Koala, which is the installation, and those are pretty much standard. So fixed time every week, non-negotiable. We're going to jump on. We're going to go through the process, the agenda of the level 10, and then the property management one. That one's longer. That one's going to probably last like 2.5 to 3 hours because it's going through all the properties. And then
Mhm.
Tri-City is the one after that where we can report all of the property management KPIs and all the health of the portfolio to the rest of the Tri-City team with the rest of the GPs and things like that on Thursday. So they don't have to show up to the property management calls. So we do the property management calls as the asset manager. I go to the Tri-City call and kind of report to the rest of the team, how everything's going.
What have you learned? How have you improved those meetings since you've done so many of them over time? For those of us who are getting into EOS or doing EOS and could benefit from improving the system, the level 10 meeting or the system in general.
The areas that we struggle on, and I can only speak from my experience on this, but the areas that we struggled on is one, we got to cut the chit chat. A lot of people, especially for the remote teams, and this is the only time they get to talk during the week, a lot of time just gets killed. Oh, how's the kids? How's stuff? And try to 3 minutes. We're cutting that off. Like we're getting into business because that can snowball, and everyone's busy, and it's like, hey, I got a hard stop at top of the hour. We got to go, and then we got halfway through the agenda. So cut the chit chat out, I think, is just out of respect of the meeting and everyone's time is something that a lot of people don't realize gets caught up. So that one's important. Running the agenda, so making sure you have a standardized form that you're filling out every week that you're reporting on, so you can track progress. The point of the level 10 is catching trends really fast because you're doing this every week. So making sure you have a standardized form where you can see where were we last week, where are we this week? Are we starting to slide in some area and catch it faster, and then hold people accountable for the jobs that they're responsible for, and projects and things like that, status updates on project, your typical project management type functions. And then the harder part that I'm really optimistic about because of the advances in AI is the data. That has been probably the most area that we've struggled, is the data to the agendas, to our spreadsheets or our systems, making sure it's as accurate as possible and as consistent as possible. Usually the life cycle for this would be you start jamming it in yourself, and then you're like, I don't want to do this anymore. So then you delegate that out to maybe a VA or something like that. And then that might work for a while, but they don't have that nuance of experience of knowing if something's off. They're just copy and pasting, from one system to another, filling out the form. So then that the data is better, but it's more consistent, but it's not as accurate as it could be. So now we're looking into, can AI do this? Can we create an AI agent and just scrub all of our systems, property management systems, bank accounts, QuickBooks, all the things, and import everything into our level 10 and our scorecards automatically? So then we just take the human element completely out of the equation. That's what we're trying to do now, is the more we can take the human element out of the equation when it comes to like data reporting, I think the more accurate it's going to be and the faster we can be at spotting trends and making decisions. And then the next iteration of that, where I'm excited as an asset manager, is once we have the data, then we can probably have some kind of AI analyze the data for me and spot, variances and, put parameters like, hey, if it's occupancy drops this, automatically flag us, things like that, or days on market for empty units, like all the things that we track, but have the AI track it and alert us before it becomes a trend. So that is what we're optimistic about when it comes to improving our level 10s. But those are the three that I think can be improved on from what I've seen in my team.
Thank you. That's such detailed information, very helpful. As far as the AI agent goes that you're creating or looking to create, where are you with that?
We're still
That
in
scrubs the
discovery.
system and imports the
Yeah,
info directly.
we've made some rudimentary ones just with some internal team members that kind of dabble. I've talked to a lot of essentially marketing agencies is what they are, that says they can build these things. So we're trying to court the right ones. And the hard part about this is it's so new that as a good investor on my end, I'm like, all right, show me the track record, show me some type of history of this thing actually doing what you say it's going to do. And that's just not there yet. So for me to, drop the money on them to develop this thing, I'm holding on to my cash tight, because if anybody's ever done marketing or this type of stuff before, you've wasted a lot of money on products or systems or things that didn't really pan out. So I've been burnt like that. A lot of people, business owners, have. So I want to see some positive results that these agents are going to do what they say they're going to do, or at least the right firm that can actually build it the right way and manage it. So that's kind of where we're at. I've interviewed probably a dozen or so different engineers that say they can build these things.
What's the pricing you're getting?
Yeah, the average that I've been getting is probably $4,000 to build an agent, and then about some kind of retainer to manage it if the links get broken or something gets broken. So retainers have fluctuated between maybe $400 to $700 a month to manage this thing, and that
Mhm.
is that it's been pretty
Got
consistent
it.
around those prices. But I just need to see some results. I just need to show me anything, right?
Let's switch to your portfolio, your multifamily portfolio, and I love what we've talked about so far, and I think it's been helpful. And I also want to get to some of the multifamily deals for those hardcore multifamily people on this call who aren't as interested in the operations and the systems, which it's all important, that's for sure. But I read something that you wrote in preparation for this interview and that we send out to our guests. And one of the questions that we ask is, what's one lesson you've learned from a mistake on a deal? And you mentioned something about a loan retrade from a lender and not sticking to your grounds and signing the document. So can you tell us a story about that?
Yes, but we're actually still in this. So this isn't a past tense story. So this was a deal. It was, how big was the property? It was 52 units, so rather small, well, relatively, I guess. So 52 units. Loan size, we're talking 6.5 million, 7 million, kind of in that range, and local credit union. And this was about C-class value at play. This is our bread and butter, right? And originally, we closed this loan in the height of everything, so 2022. So right before kind of everything started sliding, right? So 2022 is when we originally closed it. Our original loan terms was fixed rate, prime. So it's prime plus two, I think, fixed rate. And then for IO for 2 years. And then it was going to convert to amortizing at 25 years. So your typical credit union, construction type loan. So 2 years IO, and then start amortizing for the next 5 years. It was a 7-year loan term based off of prime. We were good. That's what we wrote for. I think prime, our loan at the time when we signed was, I think, like 4%, like 4.1% is what we locked at. And that's what we underwrote for. We're good. Right at the closing table, they retraded us and they switched it from you're locked for 2 years, then you reprice to market, and then you're locked for the next 5 years. And it doesn't sound like a big deal, but when rates go up 4%, right, between the time that IO burnt off, so the IO burnt off last year, right, and then now prime is 8%. Well, I think it's 7.5 today, but it's still high, right? It wasn't 2% or 3% whenever we signed.
It's
So
not
it's seven.
4.
Yeah, it's not 4, right? So it's so I think prime is 7.5, 8%, right? So now they want to relock at what prime is at now. Oh, this one wasn't a 2% spread. This was a 0.375 spread. So it's prime plus 0.375. That's how we were in the fours. That's right. And then so now they want to relock at 8, or 7.5 plus 0.375, right? So 7.75 ish, right? That's what they were going to relock at. And then, we didn't underwrite for that. So now we're trying to go back to them and, do some workout plans with them and stuff like that. Like, look, like here's our term sheet that you guys signed. Here's everything leading up to it. It wasn't until we had the loan documents, 2 days before closing that, we caught this. And then at the time we're like, we accepted it, right? Because we got the hey, let's just get the deal done, we'll figure it out later thing. In hindsight, as always, we should have stuck to our guns and probably worked with the seller of that deal and say, hey, we need, I'll put 50 grand more in the deal. Like, give us some time to work this out. That's mature Vince now should have done is bought more time with the seller, even if I had to throw another, whatever they wanted, 20 grand, 30 grand, 50 grand on earnest money to buy more time. That's what I should have done. In the moment of it, I was like, let's just get the deal done, and we'll worry about later. It's 2 years from now. Well, now we're here, so and so it'll be fine.
Mm-hmm.
The loan's not maturing, so we're not in a situation where the loan's ballooning on us, and all of a sudden now we got to pay this thing off in a high interest rate market and do some kind of cash and injection. It's just, and the cash flow is going to take a big hit, but it's still not going to tank the deal. So the deal is still pretty safe as far as just an overall business plan. But the returns just took a huge hit, as you can imagine, for cash flow. So it's, fortunately, we're still in a good safe. Our money's safe, our investors' money's safe. We don't have to refinance. We're not forced to refinance. We're not forced to sell. But that cash flow did take a big hit. So that is a recent lesson, and as recent as we're still in it. So that's our we're going to go try to work out with them.
And that banker got a big old promotion.
Yeah, right. And so the crazy part is, for the first year they denied that they did this, and then finally now, a year, 2 years later, they're starting to kind of tell us oh, well, we saw the writing on the wall that interest rates were going to go up, so we just try to protect ourselves at the last minute.
Right.
And I was like, why did it take you 2 years to admit that? But now that you admitted that, I was like, now that you admitted that, what are we going to do about it, right? So now we're going to them and showing them here's all the documentation. You guys need to make this right for us. So that's kind of what we're working at now.
Mm-hmm. One other thing I read, that you submitted is you're focused on consolidating markets to go mile deep versus a mile wide. Where are your properties currently located? Those 10 properties.
So we're consolidating to DFW is where it is. So as newer investors, especially getting to multifamily, and for a little bit of context on my GP team, I was in Hawaii. Most of the GPs were in Hawaii when we were buying. So for our original thought process, like, well, if we have to go get on a plane, we might as well just go anywhere. The deals are good. So we kind of went really wide, the mile wide, and like, oh, we have a good deal in Tennessee and Virginia and Maryland and Texas and Michigan. So we started buying everywhere. And that was good. We scaled fast, but then our operations team, mainly me, became the bottleneck because now that's 5 different property managers I need to manage. That's 30 different contractors. That's all the different landlord tenant laws in each of these different states and local economies, and it just became too much, and I became the bottleneck. And then around the same time in 2022, we kind of sat down, looked at our portfolio, and was like, all right, who's performing the best? What gives us the least trouble? What has the biggest? If we've scaled out 10 years, which of these markets has the best runway in front of it? And we just landed on, as a group, Texas, and more specifically DFW. Even though it's kind of going through some rough patches right now, still very, very optimistic on the future. So we're going to go a mile deep. I just moved down here. My partners are moving down here, at least part-time, some of them. And we're selling everything else that is not in Texas. And we're just going to go here. There's probably better markets out there for other people, but we needed to pick one market because we want to scale vertically. That's where the property management company comes in. So we're going to scale vertically, and we're just going to be absolutely lethal in one market, solely focused on here. And yeah, we'll go a little bit slower, but we'll build a much better foundation for a portfolio that way. Is our opinion on that.
So you currently have properties in Tennessee, Virginia, Maryland, and Texas?
The only ones that are left are, we have 2 in Virginia, we have 1 in Michigan, and
Michigan.
everything else is in Texas.
Okay. Where in Michigan is it?
That is in the Tri-City area, so Bay City, Midland, Saginaw area.
Okay.
Not like Ann Arbor or Detroit or anything. That's kind of up there. It's my wife's family's from that area, so that's kind of how we ended up there. It wasn't a strategic place of like, they got some demographics there that are great. It was just her family's from there, convenience. It was good.
I get it. I was born in Flint, Michigan. A lot of my extended family live there, so
so just an hour south.
It's not an area that people are flocking to, but it's slow and steady. Well, Flint, Michigan's slow and decreasing population, but those other areas slow and steady. Before we wrap up, what's something that we haven't talked about that you think we should have?
One of the kind of interesting things on this last deal. So one of the other pivots that we made, not just going a mile deep into DFW, but we also changed the product that we were going after. So normally, we cut our teeth in the C-class value add. We've done, I think as a team, maybe 18 to 20 value add repositions. Some of those, 8 or so have gone full cycle, but the last couple of deals we've purchased, we've gone after higher class assets because we just felt with the economy where it's at and the cost of construction and materials and the capex on these older buildings is just getting more and more and more. We wanted to go toward higher quality assets, or mostly newer assets, so 2010, 2020 or newer products. And so that's what our last acquisition was. It was 152 units here at 2021 construction. Great property, great deal, great cost basis. The interesting part of that, though, was how our investors reacted to our pivot from C-class value add to more of the kind of core product. Is it kind of split into 2, and we didn't really expect that. And it's not good or bad. It was just interesting. Was we had a lot of investors that were so focused on the C-class value add, like we want to see the 18 IRRs, we want to see the 2.1x equity multiples, and we want those returns. Even after kind of explaining to them, like, hey, those deals might not be great right now because of where the market's at and the cost of capex and stuff on those deals. We're moving to just higher quality assets so we can hold, and that'll appreciate when the market upswings, even though we might have to take a little bit of hit in cash flow right now because it's a lower cap rate. So we had a big group of our investors kind of decide to sit on the sidelines. But then we had this other group of our investors that have been waiting for us to buy higher quality assets. And they're like, finally, you guys are buying trophy properties. You're buying legacy properties. This is the property I want to show my buddies at the golf club and stuff like that. Like, this brand new 2020 build or 2022 build. And they doubled down. So our typical investor that might put in 100 grand, that's in that second group there, they might have doubled down to $200,000, $300,000, $400,000 for the seed because they saw what we were seeing of, let's buy higher, the flight to quality. Let's buy a higher quality asset, doesn't need capex, great cost basis. We don't need the cash flow right now, or not the same as like a C class deal rather, and ride that wave of appreciation up during the next leg up in the cycle. So that was just an interesting observation that we saw switching from or adding some higher quality assets in the portfolio, like the B pluses, the A's, and stuff like that. That we weren't expecting as a team. So I thought that was pretty interesting when it comes to a lot of people are having issues
Yeah.
raising capital right now.
Thanks for sharing the key there, because conceptually, everybody, I would think everybody to want to buy newer, nicer properties, but the reality is, do you have the equity for those newer, nicer properties? Because as you mentioned, it's lower cap rates, it's lower cash on cash return, it's lower projected returns. So do you have that? And that therein lies the challenge. And if you do have the equity that will support that, then great. I would say those are generally the properties to go after, and that you'll see that a lot where operators, myself included, start out with the older properties and then go up in class as you continue to buy more and more. Well, enjoyed our conversation, Vince. Grateful for you sharing how you've scaled, how you invest your time, and how you structure your businesses, and using EOS, using scale. Vern Harnish, right? Uh,
Yeah,
his
Gino
program also. It
Wickman
sounds like
and
prime.
yeah,
Yeah, yeah. It sounds like primarily it's EOS with the L10 meetings, and the lesson learned with the credit union, and then also your approach with consolidation and just the evolution of your business thought process and how you're continually improving, and that certainly is shown throughout your story. So grateful for our conversation. Also, I didn't mention it, but man, I'm grateful for your service in the military. Thank you so much for that. I wholeheartedly mean that, and I'm sure a lot of others would say that to you who are listening if they could right now. So I appreciate our conversation. I appreciate you sharing your insights. How can the best ever listeners get in touch with you?
I appreciate it, Joe. Yeah, absolutely. VincentGethings.com. You can go there. You can check if you want to email me directly. Vince at wheelbarrelprofits.com is another great way to connect with me. And then I'm on all the socials too. So Facebook, Instagram, LinkedIn.
Cool. Awesome. Well, hey, Vince, thanks a lot for being on the show. Hope you have the best ever day, and talk to you again soon.